You woke up this morning, checked your portfolio, and something felt off. The numbers looked different. The market was doing something strange. And somewhere in the back of your mind, you already knew. This isn't over. You were right. It isn't over. Not by a long shot. What just happened between the U.S., Israel, and Iran isn't just a headline. It isn't just politics. It isn't something that stays contained in the Middle East while your life continues undisturbed on the other side of the world. It's a financial earthquake, and the shockwaves are already moving through oil markets, through inflation, through your retirement account, through the cost of everything you buy. Most people don't feel earthquakes until the building starts shaking. By then, it's too late to move. You're reading this before the building shakes. That matters. Here's the first thing you need to understand. Markets don't wait for facts. They don't wait for peace talks, for diplomatic statements, for official casualty counts. Markets run on fear, and right now, fear is the most abundant commodity on the planet. The moment conflict of this scale becomes real, the moment missiles are in the air and the world holds its breath, money moves. Fast, quietly, and in directions that most ordinary investors never see coming until they're already on the wrong side of the trade. This isn't speculation. This is a pattern that has repeated itself with near mechanical consistency across every major Middle East conflict for the last 5 decades. 1973, Arab oil embargo. U.S. stock market lost nearly 50% of its value. Inflation exploded. Ordinary people stood in line for gasoline. 1990, Iraq invades Kuwait. Oil doubled in price in 3 months. The U.S. entered recession. 2003, U.S. invasion of Iraq. Oil began a decade-long climb that quietly taxed every family on Earth through the price of fuel, food, and goods. 2006, Israel-Hezbollah war. Markets convulsed. Gold spiked. Investors who weren't paying attention got quietly robbed by inflation they didn't see coming. Every single time. The same chain reaction. Different actors. Same script. And now Iran is in the center of it. This is not a small development. Iran is not a minor player. Iran sits on approximately 10% of the world's proven oil reserves. Iran controls, or can significantly disrupt, the Strait of Hormuz. That's the narrow stretch of water through which roughly 20% of the world's oil supply passes every single day. Every single day. Think about what that means. 1/5 of the oil that powers the global economy flows through a channel that Iran can threaten, mine, blockade, or close. That's not a geopolitical detail. That's a financial pressure point of extraordinary power. And it's been poked. Now imagine you're running a shipping company, or an airline, or a manufacturing business that depends on fuel costs staying predictable. The moment that strait becomes a question mark, the moment the word blockade enters the conversation, your entire cost structure becomes unstable. And what do businesses do when their costs become unstable? They raise prices. They pass the uncertainty downstream. They protect their margins at the expense of the consumer. That consumer is you. This is how war taxes people who never voted for it, never fought in it, and never even fully understood it. Not through a government levy. Through the quiet, relentless pressure of rising prices on everything you need to live. Gas, groceries, utilities, airfare, anything that gets shipped, flown, or manufactured. All of it touched. All of it more expensive. All of it draining your purchasing power while your paycheck stays exactly the same. That's the first domino. Oil. It's already moving. You can see it in the futures markets. You can see it in the way energy stocks jumped while everything else hesitated. The market is pricing in disruption before the disruption fully arrives. But here's what most people watching the oil price miss entirely. Oil isn't just fuel. Oil is the bloodstream of the global economy. When oil gets expensive, everything gets expensive. And when everything gets expensive, something else happens. Something that hits your portfolio from a completely different direction. The oil shock is just the first domino. There are 4 more lined up behind it, and they fall faster than most people expect. The first domino fell the moment those missiles launched. Oil spiked. Energy markets convulsed. And somewhere in a glass tower in New York, London, and Tokyo, traders started moving money before most people finished their morning coffee. But you're not a trader in a glass tower. You're a regular person with a 401k, maybe some index funds, maybe a few individual stocks. And right now, without realizing it, you're sitting directly in the path of what comes next. Let's walk through the dominoes, one by one, because each one is connected. Each one feeds the next, and together they create a financial environment that is genuinely dangerous for the unprepared. Domino 1, oil. We covered this. But let's be precise about the numbers, because precision matters here. Before the strikes, oil was trading in a range the global economy had more or less adjusted to, uncomfortable but manageable. The moment conflict escalated, that range broke. Markets immediately began pricing in a risk premium. That premium reflects one question that every oil trader on Earth is now asking. Will the Strait of Hormuz stay open? If it stays open, oil settles at elevated but manageable levels, painful but survivable. If it doesn't, if Iran retaliates by mining the strait, attacking tankers, or closing the channel even temporarily, oil doesn't just spike. It explodes. Some analysts are already privately modeling scenarios above $150 a barrel. A few are looking at $200. At $150 oil, the global economy doesn't just slow down. It starts bleeding. Domino 2. Inflation. Here's where it gets personal. You've spent the last 2 years watching inflation gradually come down from the brutal highs of 2022. The Fed raised rates. Prices cooled. Slowly, painfully, but they cooled. You started breathing again. An oil shock at this scale reverses that progress, fast, because oil isn't one item in the inflation basket. Oil is embedded in the price of almost everything. When oil goes up 40%, truck drivers pay more for diesel. That cost gets added to every delivery. Farmers pay more for fertilizer, which is petrochemical-based. That cost gets added to every food item. Airlines pay more for jet fuel. That cost gets added to every ticket. The insurance, the inflation you thought was behind you, it just got a reason to come back. And this time, the Federal Reserve faces an impossible choice. Raise rates to fight inflation and risk crushing an economy already rattled by geopolitical uncertainty. Or hold rates steady and let inflation run while the cost of living quietly destroys household budgets across the country. There is no clean option. There is no move that doesn't hurt someone. And the market knows this, which is why the second thing you'll see after oil spikes is bond markets getting nervous. Yields moving in ways that signal confusion, not confidence. That's the market trying to price in a Fed that's trapped. Domino 3, the stock market. Let's be honest about something. The stock market was not cheap before this happened. By almost every traditional valuation measure, price to earnings, price to sales, cyclically adjusted ratios, U.S. equities were priced for a future where everything goes reasonably well. Geopolitical escalation of this magnitude is not everything going reasonably well. When uncertainty spikes, when the VIX, which measures market fear, starts climbing, institutional investors don't sit and wait. They reduce exposure. They rotate out of risk assets. They sell first and ask questions later. And when the big money moves, the pension funds, the hedge funds, the sovereign wealth funds, the ordinary investor feels it as their portfolio dropping for reasons they can't fully explain. It feels random. It isn't. It's the financial system repricing risk in real time. And right now, risk just got significantly more expensive. Domino 4. The dollar and global instability. Here's the domino most people never see until it's already fallen. In times of genuine global crisis, money flows toward perceived safety. Historically, that means U.S. Treasury bonds and the U.S. dollar. On the surface, that sounds like good news if you're American. Your currency gets stronger. But a dramatically stronger dollar creates its own problems. It makes U.S. exports more expensive. It squeezes emerging market economies that hold dollar-denominated debt. It creates currency crises in vulnerable countries that then ripple back into global financial markets. The world is more financially interconnected than it has ever been. A crisis that starts in the Middle East doesn't stay in the Middle East. It travels through oil prices, through inflation, through currency markets, through supply chains, and it arrives at your front door wearing a very different disguise. Higher grocery bills, a weaker stock portfolio, a retirement account that's quietly shrinking while you're focused on the headlines. And here's the part that should genuinely concern you. Most people, right now, today, are going to do exactly the wrong thing in response to all of this. Not because they're foolish, because they're human. Because when fear takes over, the human brain doesn't reach for strategy. It reaches for the exit. And that exit? It's the most expensive door in the entire building. The exit feels safe. That's the cruelest thing about financial panic. The move that feels like protection is often the move that locks in your losses, hands your wealth to someone else, and leaves you standing on the sidelines while the recovery happens without you. Let's talk about what most people are doing right now. Because understanding the wrong moves is just as important as knowing the right ones. Right now, across millions of brokerage accounts, the same scene is playing out on repeat. Someone opens their app. They see red. They feel their stomach drop. They think, I should have sold earlier. I need to stop the bleeding. I need to get out before it gets worse. And they sell. They sell their index funds. They sell their ETFs. They sell the positions they've held for years. They move everything to cash. They tell themselves they'll buy back in when things calm down. They won't. Not at the right time, anyway. Because here's the thing about waiting for things to calm down. By the time things feel calm, the market has already recovered. The prices are already higher. The opportunity is already gone. They sold at the bottom. They'll buy back at the top. And they'll do it with complete sincerity, convinced they're being rational, convinced they're protecting themselves. This is not a hypothetical pattern. This is the most documented, most repeated, most expensive mistake in the entire history of retail investing. J.P. Morgan studied this. It found that if you missed just the 10 best trading days in the market over a 20-year period, just 10 days out of roughly 5,000, your returns were cut in half. Cut in half. Not reduced, not trimmed. Halve. And when do those best days tend to happen? Right in the middle of the worst periods. Right when everything feels most terrifying. Right when the headlines are screaming and the instinct to run is loudest. The people who ran missed those days. The people who stayed captured them. That's the brutal arithmetic of panic selling. It doesn't protect your wealth. It donates it. To the investors who kept their nerve while you lost yours. Now let's talk about the other side of this moment. Because while millions of ordinary investors are heading for the exit, something else is quietly happening. Money is moving. Not disappearing, moving. From weak hands to strong ones. From the emotional to the disciplined. From people reacting to people who already had a plan. This is how wealth transfers happen during crises. Not in dramatic, obvious ways. Quietly, systematically. While everyone is distracted by fear, think about 2008, the financial crisis, pure, unambiguous catastrophe, banks failing, unemployment surging, the media announcing the end of capitalism on a weekly basis. Warren Buffett was buying, not because he knew exactly when the bottom would come, not because he had information nobody else had, but because he understood something that most people forget the moment fear arrives. Price and value are not the same thing. When panic drives prices down, the value of strong businesses doesn't disappear with it. The fear is real. The price drop is real. But the underlying value, the earnings power, the competitive position, the long-term trajectory often remains intact. Panic creates discounts. Discounts create opportunity. Opportunity rewards the prepared. This is not about being reckless. This is not about ignoring risk or pretending the situation isn't serious. The situation is serious. The risks are real. But serious situations have always, eventually resolved. And the investors who positioned themselves during the fear captured returns that the ones who fled never saw. 2008 recovery. The S&P 500 tripled over the next decade. 2020 COVID crash. The market recovered its losses in 5 months. 5 months. And then kept climbing. Every single time the world felt like it was ending financially. For those who stayed disciplined, it wasn't the end. It was the setup. But here's where it gets complicated. And this is the part most financial content won't tell you honestly. Staying disciplined doesn't mean doing nothing. It doesn't mean closing your eyes and hoping. It means making intentional decisions about where your money is positioned and why. Because not everything falls equally in a crisis like this. And not everything recovers equally either. Some assets get destroyed by geopolitical conflict. Others get forged by it. They get stronger, more valuable, more essential precisely because the world is unstable. The difference between the investor who survives this moment and the one who gets consumed by it comes down to one thing: positioning. Knowing which side of that divide your money is sitting on before the shaking starts. And right now there is one move, one specific, counterintuitive repositioning that most people will hear about, understand intellectually, and still refuse to make. Because it goes against every instinct. It feels wrong at the moment it matters most. But it's the move that the disciplined investors, the ones building real wealth through chaos, are already making right now, quietly, while everyone else is watching the headlines. Here's the move most people won't make. Not because they don't understand it, but because it requires something that panic systematically destroys: conviction in the middle of uncertainty. Before we get there, let's build the full framework, because protecting your wealth during a geopolitical crisis isn't one move. It's a coordinated set of positions that work together, each one serving a specific purpose, each one covering a specific vulnerability. Think of it like a fortress. A fortress isn't just a wall. It's multiple layers of defense, each one designed to slow, absorb, and redirect an attack. Your portfolio needs the same architecture right now. Layer 1. Energy. This one isn't counterintuitive. It's just something most people act on too late. When oil spikes, energy companies make more money. Simple cause and effect. Their revenues go up. Their profit margins expand. Their stock prices follow. If your portfolio has zero energy exposure right now, no energy ETFs, no oil majors, no natural gas producers, you're not just missing an opportunity. You're fully exposed to the cost side of an oil shock with none of the upside. Energy stocks are not a speculation right now. In the context of this conflict, they are a hedge. They're the part of your portfolio that goes up when oil goes up, offsetting the damage that rising energy costs do to everything else you own. The time to add this exposure was yesterday. The second best time is now, before the next escalation, before the next headline, before the next spike. Layer 2, gold and hard assets. Gold has been called a relic by sophisticated investors for decades. Every few years, someone writes a very confident article explaining why gold is irrelevant in the modern financial system. And then the world destabilizes, and gold does exactly what it has done for 5,000 years. It holds value when paper assets don't. Gold doesn't pay a dividend. It doesn't generate earnings. It just sits there, ancient, patient, and indifferent to whatever crisis humans have manufactured this time. And in moments of genuine geopolitical uncertainty, money flows into it with remarkable consistency. We're already seeing it. Gold is moving, not because traders suddenly discovered it, but because institutional money is rotating into safety. And when institutional money moves into an asset, the price follows. This isn't a trade. This is insurance. And like all insurance, it feels most valuable precisely when everything else is on fire. Silver, commodities, real assets. They belong in the same conversation. Anything with intrinsic physical value tends to hold up when confidence in financial systems wavers. And right now, confidence is wavering. Layer 3. Defense and cybersecurity. Wars are expensive, and the companies that supply the tools of war, the weapons manufacturers, the defense contractors, the cybersecurity firms protecting critical infrastructure, they don't suffer during conflicts, they get contracts. This is uncomfortable to say out loud. It feels wrong to talk about profiting from war. But the market doesn't have a conscience, and understanding where government spending flows during conflict isn't immoral. It's just accurate. Defense budgets across NATO countries were already climbing before this escalation. They're going higher now. Cybersecurity spending was already a priority. Every government on Earth is acutely aware that modern warfare isn't just fought with missiles. It's fought with code, with infrastructure attacks, with financial system disruptions. The companies positioned at the intersection of those priorities are not going to suffer in this environment. Layer 4. Cash positioning. Here's where it gets counterintuitive. Most investors think of cash as the safe move, the thing you run to when you're scared. And in one sense, yes, cash protects you from immediate market volatility. But here's what cash actually is in an inflationary environment. It's a melting ice cube. If oil spikes and inflation returns at 6, 7, 8%, your cash is losing purchasing power. Every single day, it sits idle. The number in your account stays the same, but what that number can actually buy, quietly, invisibly, shrinks. So cash isn't the destination. Cash is the weapon. You hold cash not to hide from the market, but to deploy into it when fear has pushed prices low enough to create genuine value. Cash is ammunition, and ammunition is only useful if you have the discipline to fire it at the right moment. Not when everything feels safe, but when everything feels most dangerous. The investors building wealth right now aren't hoarding cash out of fear. They're accumulating it with intention, watching, waiting, ready to buy quality assets at panic prices when the herd is selling. That's the counterintuitive move. Preparing to buy while everyone else is racing to sell. Layer 5. Geographic diversification. The United States is the world's largest economy. U.S. markets are the deepest and most liquid in the world. But right now, U.S. markets carry a specific risk that markets elsewhere don't. Direct entanglement in this conflict. That doesn't mean abandon U.S. stocks. It means recognize that having 100% of your investments concentrated in one geography, any geography, is a structural vulnerability. Markets in parts of Asia and select emerging economies and commodity-exporting nations, they respond differently to Middle East conflict than U.S. markets do. Some of them benefit directly from higher oil and commodity prices. Diversification across geographies isn't just about chasing returns. Right now, it's about reducing concentration risk at a moment when concentration is dangerous. Now, step back and look at this full picture. Energy exposure to benefit from oil spikes. Gold and hard assets as insurance against instability. Defense and cybersecurity aligned with where government spending flows. Cash held as a weapon, not a hiding place. Geographic diversification to reduce concentration risk. This is not a panic portfolio. This is a conflict-aware portfolio. Built not on fear, but on clear-eyed recognition of what this moment actually is and what it historically leads to. Here's the final truth, and it's the one that separates every successful long-term investor from every cautionary tale. Chaos is not the enemy of wealth. Unpreparedness is. Every major crisis in modern financial history, every war, every crash, every panic, every moment the world felt like it was genuinely falling apart, created two groups of people, those who were consumed by the chaos, and those who used it. The ones who got consumed weren't stupid. They weren't weak. They were just caught without a framework, without a plan, without the emotional architecture to act rationally when everything around them was irrational. The ones who used it weren't lucky. They weren't heartless. They simply understood one thing that most people never learn until it's too late. The market rewards preparation, not prediction. You don't need to know exactly how this conflict ends. You don't need to predict the next headline or time the next move perfectly. You just need to be positioned thoughtfully, deliberately, with clear reasoning behind every decision before the next wave hits. Because the next wave is coming. It always does. The question was never whether the world would create chaos. The question is whether you'll be ready when it does.